It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the topsy-turvy world of equities these days. If you don't like where they are, just wait 5 minutes. Another one of those markets, certainly today, listeners, as equities taking a bit of a drubbing, but maybe bouncing off the lows here again as they are wont to do. We're seeing all sorts of strikes and handles flying fast and furious out there in zero DTE land. Pick a strike, and chances are it's got some action on it this week. Already the E-mini putting up nearly 3 million contracts out there. So a pretty active week, all things considered, even as we are vacillating around a little bit shy of where we used to hang out not too long ago. In fact, we were just talking on the option block about an hour ago that we had gone negative for the year, if ever so briefly. But now it looks like the market's trying to struggle and stay above that level, at least for right now. But Kevin, as you mentioned at the top there, it's been a wild start to the year out there in the world of equities. What is catching your eye, sir?
Yeah, well, just in general, I think we are just seeing a little bit more of a rotation trade, and that has been kind of the theme. And it's actually pretty healthy. I think this is actually a correction in time. We are seeing the market pull back here, and I think that's also a good thing. You're starting to see maybe a little bit of diversification outside of technology, getting into other industries and other sectors like industrials. Materials obviously has done fairly well. Consumer staples now kind of catching, grabbing that baton. I think what you get a little concerned about is if we start seeing a lot of these sectors that have been performing well over the last month or so, starting to, give up some of those gains as well. And this is just the normal type of trading action that we see in a January and February. The seasonality is actually very tough in February. So we have seen volatility stay and remain elevated. And I think that's going to be your telltale sign. Once you see volatility crush below, let's say 16 and a quarter, I think you got to keep your head on a swivel in this market right now.
Yeah, we have been vacillating all over the place in the S&P today as we're coming in to start the show, hanging out right around that 68.75 level or so in the S&P. And as you might imagine, just about every relevant zero-day strike you can think of has been lighting up the tape today, and indeed earlier this week. I'm just looking at all the different strikes out there, and we have a lot of action in just about every strike you can think of, including, let's see, this just today we saw the 70 quarters lighting it up 14,000 times. Coming into the start of the show, everyone's favorite, the 7,000s, the pars, up about 10,000 times just today. It's not even counting the volume they did earlier in the week. About 12, almost 13,000 of these 70.75s. I'm going to hope for whoever traded those sake that was part of maybe a vertical. Maybe it was a 70 quarter, 70.75 vertical. I'm hoping they're selling those, but we shall see. And even 69.85s getting some love today, going up nearly 12,000 times. So again, pick your strike. Weirdly enough, to the dark side, we have the about 6,900 puts going up about 8,000 times today. And then we have the 68 half puts going up about 8,700 times. So again, as you would expect, zero day is dominating the picture. Right around a quarter of the week's volume so far has gone up in this contract that is now expiring in a little bit here today. So again, 25%, that shows you how zero day heavy. If you add in tomorrow's volume as well, the contracts that are expiring tomorrow, you're talking about 43% of the flow out there, and you go out a whopping 5 days, now you're talking pretty much 50%. So that is pretty much the percentage we've come to know and love out here in the E-mini. That said, there has been some other flow lighting up the tape out here this week, including a little bit farther out, which kind of caught our eye coming into the start of the show. Going out a whopping 22 days. It seems like an eternity these days, Kevin. We've got somebody lighting up today, the 6,500 puts. These are week 1 March, again, expiring in about 22 days. Changing hands nearly 3,000 times today. It doesn't look like it's a vertical or anything else. It seems like it's straight up about 3,000 of these. Worth noting is about 3,400 contracts open, so it could be someone bailing on these. And then they also traded the day before. It looks like it might have been a 6,500, 62 half, maybe 6,900 put. Could be a ladder, could be all sorts of funky constructions going up about 2,500 times each versus about 1,000 of these 6,900 puts. So some 22 day to go March downside lighting up the tape. I didn't really have that on my bingo card. Does that float your boat, the 6,500 strike going out in about 22 days in March, Kevin?
Yeah, I mean, it kind of makes sense, especially if you're hedging a portfolio, which a lot of these institutions are utilizing these options in order to do so. And if you kind of look at the chart, the 6,500 level was a key area of support that we saw back in November, pretty much actually the day before Thanksgiving. That was an area of support. And actually, if you go back on October 10th, 6,500 once again was a major area of support. So if somebody's looking for a little bit of a hedge, as well as the market just kind of rolling over. I mean, Mark, let's talk about the technicals really quick. It does look like it wants to roll over to the downside here. We did clear a new low over the last couple of days, and so that probably is more of a hedge bet. I would assume, and we'll see exactly how the market kind of handles this. But you still have that window. The next 20 days or so, usually the volatility is going to be there. And you also have the inflationary print tomorrow, the CPI print, which I think is going to be one of the volatile ones that we have seen in a very long time. January is usually volatile. So I think this is probably a hedge position and kind of makes sense when you're looking at the technicals.
Well, you mentioned the rotation out of large caps into small caps. That has been a narrative a lot of people have been fixating on, including us so far this year. I'm not sure where you're rotating today because small caps are off about 2.5% almost. So they're getting annihilated. Everyone's rotating out of everything, it seems like. Today, but that has been the trend for the most part for the first at least roughly almost 6 weeks of the year here. In fact, interestingly, you'd expect a little bit more flow to be lighting up the tape if we go out to the Russell 2000 than we're seeing right now. You know, these days we're starting to see 50, maybe 60,000 contracts going up in a week. A lot more than it used to be, but obviously not hitting that this week. Only about roughly 30,000 contracts going up out here this week. 32,000 hitting the tape in the Russell 2000. So I guess a 2.5% sell-off roughly in one day, Kevin, is not enough to drive some flow in the Russell 2000. But it sounds like this is the trend you've been noticing as well. Folks may be tiring a little bit, taking some profits, call it what you will, in their beloved big tech names, and maybe finding some greener pastures out there in small caps with the exception of today, sir.
Yeah, well, like I said, I think this is actually a correction in time at this point. We might actually start seeing asset values moving to the downside aggressively. But if you even look at some of the technology stocks or even the software sector alone, we've already seen a correction there. Microsoft's been in a correction. Meta's been in a correction. So a lot of the froth has been taken out of this market. The rotation can also create these smaller sectors like, let's say, utilities or even materials for that matter that don't really actually have a major impact in the S&P 500. And it really doesn't take that much to move those sectors. Now, some of those might be a little bit outstretched. Materials, you're starting to see a rollover within a lot of those metals. We just talked about it, the light side and dark side. The material stocks are going to trade with the metals. So that could be something that does kind of roll over here. And you are seeing consumer staples catching a bit as well. I think that's also one of those catch-up trades. Consumer staples really has not participated with the market over the last 3 years. It's obviously outperforming now. And then you have energy. Once again, smaller sector, doesn't take much to kind of move that. It also has a tailwind of geopolitical risk. But I would not be surprised after the next 20 days or so, you start seeing individuals nibbling back into those technology stocks because that's usually where the growth is for this market. And I think this is a stock picker's market, really. Or if you're trading the indexes, you got to be very tactical in this market because everything's kind of waning. You know, I do want to highlight something today that is catching my eye, and I want to put it on your radar, put it on the options trader radar. Look at commercial real estate stocks. That is actually very concerning when you're looking at a lot of these stocks that have dropped like 30%, 40% in a matter of 2 days. There's a theme there that I think is probably going overlooked right now in mainstream. I'm starting to look at it a little bit more, but you look at companies like CBRE, that stock has dropped like 20%, 25% yesterday. I think it's down another 15, 20% today. You're talking about great financial crisis type of pullbacks in certain pockets of this market on the industrial and the commercial real estate side that I think we need to probably keep our eye out on.
Not an area we've talked about in a while, you're right, but certainly lighting up the tape out there today. Might have to do a little bit more digging on that one after the show as well. But since we're talking small caps here really quickly, let's look at some of the other action that's lighting up the tape out here in all things small caps. By the way, as we're coming into this segment of the show, hanging out right around 26 and a quarter or so in the Russell 2000 over there at CME. We're seeing a lot of wreckage in the 0-day and short-dated upside from earlier in the week. Just a lot of money going to die, it seems like, on those strikes. 28 quarter, 27 quarter, 2,700. they were trading all week long, and pretty much all of those are for the most part, vestigial strikes. Now, hopefully they were blasting away on all of them, but if past is prologue, probably not. 2800's also lighting it up out here this week. All those expiring in about 1 day at this point. And again, not looking very relevant for most of those strikes unless we get a massive move in small caps tomorrow. We did see some put action earlier this week, and maybe this was a little bit more well-timed, including 2600 puts and the 26 half puts, and indeed 25 quarter. It'll be interesting to see if those can be relevant by tomorrow's expiration as well. So interesting action on those. By the way, if you want to go a little bit farther out, as we know, Russell 2000 likes to trade not just 0 day, but also usually about 1 month out and a lot of downside. And in this case, it's a March, what looks like a March put spread, even though, I mean, it looks like a duck and it quacks like a duck, so it's probably a duck, even though I don't think it went up as a put spread. But it was the 2600, 2400 put spread in March. This is week 3 March, so it has about 36 days to go, listeners. It's traded almost 1,000 times today and another like 350 times on Monday. Again, looks like it was a put spread. It prices up around close to $25, about 24 3/4. So is that a level that floats your boat? Again, about a month ago, Kevin, 2600, 2400 put spread in the Russell 2000, sir?
Yeah, I mean, you're looking at something that was trading pretty much at 50 delta earlier today. We did see a bounce off of the Russell futures today. And if you're kind of looking at that spread from that current level or that 2600 level, you're looking at around an 8.5%, let's say 9% move to the downside until you get to that lower strike of 2400. So once again, this could be one of those put hedges, maybe for a larger portfolio. Maybe it's an outright move to the downside that they are pricing in, but they're getting a little bit more delta on this trade. And that's probably one of those environments, especially when you have higher volatility and you get these aggressive spikes down, having that type of, a closer delta in a spread fashion allows you to realize profits a little bit earlier than if you get something a little bit farther out of the money, which obviously you're going to need to have a little bit more of a move and or a higher spike in volatility in order for you to kind of get in and get out.
Speaking of far out of the money, this one just caught my eye right before showtime, Kevin, and it brought a smile to my face. Someone slung 100 out of the 24 half, 27.75. These are going up in March, so you got about a month to go. Strangle. So slinging strangles out there. Pretty far out of the money in both directions. If you're wondering, listeners, not quite $45, $43.50. So if you want to take a nibble, that's your price. If you'd rather sell those strikes, then nearly $45, Kevin. Is that enough for you to maybe nibble to the dark side, sir?
To sell a strangle, you can't pay me enough. I've been burned way too many times, Mark. I like my risk-defined strategies and not having to worry about anything.
What can go wrong with net short units, Kevin? I'm not sure why you would poo-poo such a thing. But yeah, a lot of action in the equities, obviously, listeners, and I don't think we've seen the end of it for this week. We'll see what tomorrow holds in store for us